Capital Advisory for Generation PMCA, and Badr Shamim, Vice President of Portfolio Management for Generation PMCA. Today's topic is about the economic recovery and specifically investment opportunities related to the economic recovery. Today's expert series is brought to you by the kind sponsorship of CN, of Toronto Pearson, of Deloitte, and also of Goodison Insurance. Jai and Badr, if I could ask you to, there you are. There's Jai and Badr. There's Badr. Fantastic. It's so good to see you both. It was just a few months ago that we did a touch base. We were, I guess, halfway through the pandemic at that time, and we learned about some trends that we're developing as well as what's happening in mergers and acquisitions. And I understand that, Jai, you will talk a little bit more about that today, but we're going to start with Badr. And if I could ask you to unmute yourself there, Badr, we're going to start with a question about where we are now and how your company, as a wealth management company, is positioning itself as vaccinations roll out. We're picking up pace there. What is Generation PMCA doing to position its investments on behalf of its clients to take advantage of the economic recovery, which is on its way?
First off, thank you, Todd, for inviting me and Jai to be on the expert series again and have an opportunity to share our company's outlook with the Brampton Board of Trade members. During our last appearance on the series, we had shared our outlook that while technology sector had started to cool off, the value stocks, which are primarily represented by cyclical sectors such as financials, industrials, commodities, and energy sector, they had started to recover from their COVID lows. So we at Generation made some opportunistic purchases in those sectors, and more recently, with the recent deployment of COVID vaccines, both here in the developed world, in Canada, North America, Europe, and with historically high levels of fiscal stimulus being injected, in the global economies, led by, again, the developed nations and the G7 nations, we're starting to see extremely high market valuations, prompting us, to be a little bit more careful, be more watchful. We're seeing very high levels of speculation, which is very evident, actually, if you're looking at asset classes representing a crypto SPAC space, with everybody, including even celebrities pretending to be investment advisors, giving advice along the lines of those asset classes too. So in an environment like that, searching for undervalued companies is becoming more challenging. And while we continue to maintain our exposure to those value-oriented cyclical sectors with some exposure to technology, we're starting to now basically hedge against a potential pullback in the market by shorting the S&P 500 index. That's an attempt on our part to preserve our clients' capital and the growth we have had in recent months. And at the same time, we continue to look for some undervalued companies. Generally speaking, though, we're seeing more value, more undervalued companies in markets like China, Japan, European Union than here in North America these days.
Oh, that's very interesting, Badr. Thank you very much for that overview. So, buyer beware, some higher than normal market valuations, some speculation happening there, and your response in order to find undervalued companies, which again is an important strategy, is to look at different markets, China, Japan, EU, and you're hedging by shorting the traditional S&P 500 index. So very astute approach during these uncertain times. Now, tell me, what are you hearing from your customers? What are is there a change in where they want to put their money, what their priorities are, societal priorities, for example. What are the big shifts you're seeing in investors around and their outlook for investing?
Yeah, so Todd, I think COVID pandemic has allowed us to do a little bit of introspection over the last little while. And the biggest shift in investor behavior over that period is a preference to invest in companies that provide the solutions for the problems facing our world. And people would like to see businesses that are contributing towards environmental, social sustainability. They would like to support businesses with good governance, while they would like to see companies in their asset mix produce profits, obviously, they would also like to see alignment with shareholders in terms of being prudent towards deploying capital and fostering a culture that promotes equity, inclusion. So this is something we have always paid attention to at Generation PMCA. However, more recently we have created a systemized process whereby we have launched our ESG strategy based on an in-house composite rankings of approximately 1,200 global companies along the ESG lines. Those that are interested amongst your members to learn more about what matrices we're using, they're welcome to visit our website, generationpmca.com, and just look under the investment strategies under global value ESG model, and they would be able to find all the details in terms of how we're ranking those companies, and equally importantly, how the companies are currently ranked. So there's a lot of companies to sift through, and I think it's a very interesting opportunity for Bramptonians at large, and more importantly, Brampton Board of Trade members to visit our website and see which global brands we think are very much aligned with their outlook going forward.
So that was generationpmc.ca for a review of the companies that you're looking at from and the matrices, which with environmentally social responsible governance objectives. Is that right?
Yeah, generationpmca.com.
.com. Yes.
Yeah,
Okay.
and if you visit the website, you will see a tab that says investment strategies, and within the investment strategies, you'll see all the strategies listed, but under ethical strategies, you'll see the ESG model listed.
Right, under ethical strategies. Well, that's great. We're seeing a demographic shift as well. We're seeing more younger investors crossing the threshold, looking at new investments, and these ESG objectives are something that's first and foremost in terms of their priorities. At least they know that from an introspective, from a societal benefit perspective, that they would prefer to invest in those types of companies. But certainly they do need advice from the good people at Generation PMCA to apply a system to evaluate. I mean, anybody can put anything in their annual report about ESGs, but the value that you provide in taking a critical eye to them and balancing with profits, with dividends, etc., is so important. So very good. I will look at that myself under ethical strategies on your website, generationpmca.com. Jai, hello. How are you? Good to see
I'm
you.
doing great.
Yeah,
Delayed
that's
reaction.
great. That's great. We were talking earlier how your family has their first vaccinations and looking forward to the second. And it's always good to talk to Generation PMCA, particularly this topic about economic recovery. And I understand that you might have a short presentation for us and might help us better understand different sources of private equity that's available to business owners. Business owners are doing a lot of introspection right now about their future. A lot of them, this last 14, 15 months has taken a lot out of them. They're rethinking about their business, about possible sales, about passing on to next generations, about collaborations and mergers and acquisitions. And I understand you're going to comment a little bit about private equity that might be available to help them with that thinking, or if they're not going to make a change in ownership to help them find private sources of equity to help them with their growth. So what's the latest happening there?
So Todd, in our last presentation, um, last December, I touched on the importance of looking at different strategies to stabilize or create opportunities during the pandemic for growth companies or companies that needed to strengthen their balance sheet. And we looked at the time we looked at 7 or 8 strategies around mergers and acquisitions. What I wanted to do was to expand on that and share some ideas around um, finding and really aligning with scalable capital. And so that's what my presentation will be focused on today. I'll share my screen with everyone, so just bear with me for a moment here. Can you see that? Perfect. So the pandemic's been, it's been challenging for a lot of companies, but it's been an exciting period for some, especially where we are locally in Brampton. We've had a fairly thriving economy over the last year because of our exposure to essential workers, essential businesses, manufacturing, logistics, and so on. I wanted to touch on mechanisms that are available for companies to finance their growth, their acquisition strategies, and general transitions. So what I wanted to touch on really is alignment of funding. Funding is finance and capital is really the lifeblood of all business, all growing business. And it's always a challenge to find the right type of funding. It's always a challenge to find funding in general. But what we think is really important is really finding the right capital partner that can support your mandates and your growth over time.
Yeah, you want patient money. You want it not only at the right price, but folks that, as you say, are aligned to your own objectives. Tell us more.
And so, there are many different funding sources that are available to businesses. At the earlier stages, companies tend to rely on internal capital, that is investment from senior management or the entrepreneur behind these businesses, other senior partners, and friends and family. Those are typically the go-to source for capital. But as you grow, you typically require capital that scales beyond your inner circle. And this is where some of these other capital sources are really important. So we can look at strategic investors, financial investors. And alternative financing is an interesting space as well, where for the day-to-day operations of your business, you can look at working capital financing through lines of credits, merchant cash advance type facilities, or invoice financing to cover those short-term cash flow requirements. And then as you grow larger and you start to do acquisitions or major expansions, private credit has become a really interesting source of capital over the last few years. In Canada, in particular, this is a space that's really now experiencing a big growth phase. Going back to, let's say, just 5 years ago, we had a handful of operators in this space, and we now, through the pandemic, we've seen new entrants into the private credit space where a handful of large funds have been created. And these are investment funds funded by institutions and high net worth individuals. And you now see billions of dollars being poured into the space. And it's exciting because it brings new avenues for capital for private companies. I'll touch on 3 of the sources of capital that we think are really good, scalable sources of capital that entrepreneurs should really consider to align themselves with over time as they pursue growth strategies or expansions.
Well, this is really helpful. Thank you. Please continue. I was just going to comment that, when it comes to private capital, a lot of entrepreneurs are intimidated by it. So I think your insight here will be very, very valuable.
Yeah, it's been interesting. When you look at private businesses, the banks have moved away from funding or providing traditional funding to this space. And a lot of that has then sort of been moved out to a bigger market of private capital. And those sources of private capital tend to have better alignment depending on what segment your businesses are in, and you have a lot of flexibility in terms of what type of capital you're accessing, whether it's equity investors to support your business or debt capital to expand the business.
So there's really no need to fear accessing private capital. In fact, you're dealing with people that are like-minded, that have, in many cases, been successful in business, and therefore you can tailor something that fits best for you rather than being bound by, a traditional bank or institutional requirements. So yeah, please tell us more. This is helpful.
In many cases, these sources of private capital provide much better alignment because they not only do they give you access to the money, but you then also have access to a network and expertise behind those sources of capital. So in some cases, whether you're aligning yourself with a private equity firm or a private credit firm, in cases of a private equity firm, it might be that they own a number of businesses in your segment, and they have a very deep understanding of what's happening within that segment, and they're able to really support your business beyond just the capital infusion. So let's look at these three that I'll highlight here. So the first is strategic investors. We think that this is an interesting source of capital, and often it's a source that's available to a lot of folks, and they ignore it because strategic investors are often coming from your own clients, your supplier base, and or competitors. And so I think there's a hesitancy by entrepreneurs to align themselves with competitors or other types of strategic investors. However, there are lots of good advantages to aligning with strategic investors in that, the first that comes to mind would be their timeline. For the most part, these investors, they want to invest in your business because there's a lot of different avenues to align. They may have an existing business in your segment. They may have certain assets within their company that aligns with your offerings, but they're typically looking at this from a longer term horizon. They're not looking at this as an avenue to profit from your revaluation of the asset as you grow. They're there for the long haul, and they could potentially be either good merge partners in the long run or partners that you can sell to or access more capital along the way. So these are great avenues to pursue. The other group that I think is really interesting and available today are financial investors. A lot of folks in business, when they think of financial investors, the first group that comes to mind would be a venture capital or angel group. And at certain points in your business, those may be the right sources. But as the business grows, I think that groups like private equity platforms or family offices or larger investment holding companies are interesting avenues because they tend to bring different resources to support your business as well. Private equity platforms are interesting because when they invest in a certain business, the approach that many of these groups take is that they build what's called platform companies. So they would invest in a certain segment, they would buy a large company in that segment, and then they look for add-ons to expand on that business with the intent that they can grow as a whole over a period of time. Now, one of the common characteristics of each of these groups is that financial investors are different from strategic investors simply because they're there to capitalize on the growth of your business. They're there as investors. They want to profit from near-term catalysts that they see in your business, or inefficiencies within your business that they can come and help to add value to. Nevertheless, this is a group that's that we're seeing a lot more activity in, and for growing companies, this is a great alternative, a great way to access capital.
Jai, how would you distinguish between family offices and the other financial investors?
Todd, that's a great question. So family offices are interesting. Many of the family offices that we see within our network are really families that have sold a successful business at some point, and they're sitting on wealth that's in some cases multi-generational wealth that's been accumulated, and they're prudently reinvesting that the proceeds from that sale into multiple businesses. Often what you'll find is that some family offices like the idea of staying within the segments that they have expertise in, while others will look to diversify their funds across many different sectors. The advantage of getting a family office investor to back your business is typically they have an established network around them. They're a good source of capital, and they tend to be longer term investors as well, in that we know of a number of family offices that tend to invest in companies and hold those stakes for 20 plus years, because they see a longer term story at play that they can contribute to and they can add value to over time. Similar with holding companies as well. Investment holding companies tend to be either funded by whether it's government bodies or other institutional bodies, where groups of investors and professional investors come together for a common objective of supporting a certain sector, for example. And so you may have alignment where you have a three-peat partnership of some sort, maybe private investors, public investors coming together and supporting a certain segment. They tend to have a set mandate to establish growth in a certain segment or economy.
Yeah, and if you play your cards right, you might be adopted by the family offices too. Sorry, bad joke.
That tends to happen as well. So I touched on private credit groups. I think that this is an exciting space that many entrepreneurs are not paying a lot of attention to. It's not a very well understood segment out there, but we're seeing significant growth in this segment. Many of the large traditional pension funds, insurance companies, and big institutional investors across the board have been contributing and investing in private credit mandates. And what that does is that it then creates a pool of capital available to support businesses at varying levels. I think one of the misnomers out there around private credit is that a lot of businesses or entrepreneurs tend to feel that they need to be much bigger to access private credit. And that's not always the case. We see private credit transactions all the way down to $5 million per commitment. And on the upside, it's unlimited. These are groups that can support large acquisitions, large mergers, that sort of thing. What's interesting about capital from private credit groups is that it's debt capital. So it does not affect your equity ownership or equity structure of your company. The owners retain full control of their stakes in the company.
And the trade-off is that it's a little more expensive, though, right?
It can be, but in the long run, it's cheaper capital than equity capital.
That's right.
It's also a lot more flexible than many of the other structures, right? private credit investors tend to be flexible because they're supporting segments that they are very much aware of. They spend a lot of time to get to know certain segments that they're clearly they identify clear advantages and they can support those segments. So they're willing to provide, whether it's senior secured financing or mezzanine financing, or we look at some structures that merges these two concepts together in what's called unitranche, where a single lender can come in and provide you with your senior financing and some other form of financing, equity or mezz financing as well.
And that flexibility is quite valuable. It can provide a lot of peace of mind for a growing firm as well. And like you say, protecting the owner's equity. Good evaluation there of the different.
That's right. So the flexibility comes in many forms as well. They tend to have varying terms to their loans. It's not always an expensive proposition. We see private credit structures. It really depends on the business that you're looking to finance and what the balance sheet looks like, management capability, and the segment, what's happening in that sector at any given time. But I think private credit is interesting because it really comes in handy to support a lot of the structures that we discussed in our last presentation around mergers and acquisitions. So we looked at doing a merger to strengthen your position, grow revenue, create better financial stability for your platform, expanding your offerings, scale and consolidate within a sector. Each of those requires some form of capital, some form of financing. And we see private credit as a way to accomplish bigger transactions at a shorter timeline. These groups tend to be much better at turning around and granting you funding faster than traditional banking facilities would be.
Yeah, another really good point in terms of peace of mind is the decisiveness and the shorter turnaround time for private credit. That's great. We've included in the chat for our viewers as well. I'll just let them know your original presentation from December as well. Great work here in terms of building upon that presentation to show us the full landscape of private equity options. Very, very good. What else do you have for us, Jai?
We think that within this landscape, whether it's private equity or private credit, what's interesting is we're starting to see more and more transactions within the private space. We're starting to see more and more companies become open to looking outside of their close circle for opportunities to grow, for opportunities to expand within their product lines or to capture new technology. I touched on some of the areas that you can use private credit to support. This is just a list of some of those things. One of the others that I missed earlier is there are clear advantages to using private equity investors or inviting a private equity investor to the platform as well. We've had a number of transactions that we've supported recently where we saw clear advantage of bringing larger private equity groups to support growing companies. Many situations, and we touched on this in the last presentation, where we have a lot of larger companies out here where entrepreneurs are hitting a point where they're close to retirement and they're starting to look at options. And we view, private equity as a great alternative when considering succession planning and looking at ways to, to continue to support your business, but managing that succession plan. So I think in some ways, those private equity transactions go hand in hand with accessing capital through private credit as well, because succession can come in a lot of different ways. It could be that you acquire a company with good management. That one of the things that we discussed the last time by creating expertise or bringing on expertise that's really growing your business, but it also allows you to have a succession plan in place. So those are some of the advantages. Having good alignment to great financial or capital sources can really help you to accomplish some of these mandates.
Well, that's a great overview. And is there more to your presentation, Jai, or is the?
I think that's it for now. I want to keep some of the good stuff for the next presentation, Todd.
Fantastic, fantastic. Well, listen, I want to say thank you because you have been, as usual, very succinct, very value add in your presentations. Just a reminder to people that we have put the last presentation in the chat as well. You can access that, view that from our website together with this one. You provided a very good, comprehensive look at the landscape of private equity, private credit, and the differences between them as well in terms of flexibility, in terms of patience, duration, some of the additional benefits you get through investor understanding of the business, of the industry, some of their strategies with respect to platform and plugging in. This has been very, very helpful. Badr, as always, very helpful presentation as well in terms of what investors are thinking about, and a little bit about how the market's getting a little more challenging to find undervalued companies and where we might look for those different parts of the world. So all in all, I think this has been a very good touch base. Again, I want to make sure that folks know where they can learn more about your strategies. Of course, we will be posting this later today on our website, but you can also go directly to generationpmca.com and learn more about these strategies, the services that Jai, the Vice President of Capital Advisory, or Badr, the Vice President of Portfolio Management, can provide. Of course, the global ESG model is there as well under the tab on ethical strategies. And once again, I just wanted to say thank you to both Jai and Badr for your time here today.
Yeah, thanks for having us, Todd. One quick tidbit: if you go to our website, you'll be able to actually find all of our previous client communications and our newsletters. So you can actually see the philosophy and the outlook of the firm over a period of a few quarters, and not just what we're doing currently, right? So it gives you the whole story.
Well, that's wonderful. Thanks for mentioning that. Well, that's good, and I will do that. And I'm going to take you up on that offer, Jai. You're holding some stuff back for us for the next the next interview, or we appreciate that very much. I always learn something new. It's always great to have the interaction among the three of us as we talk about the interesting opportunities as we move closer towards recovery. I just wanted to let our viewers know that we are having another expert series next week with a company called Absolute Change Management, and their focus is knowledge transfer. So if you're looking at retiring, if you haven't yet got your exit strategy in place, you might want to tune in next week, 1 o'clock, May 27th, and we'll be having a conversation that drills down a little bit deeper into what you should be thinking about in terms of your exit plan, how you can capture knowledge of key personnel that may be retiring or leaving the business. So that's 1 o'clock, May 27th. June 3rd is an open invitation to businesses that want to be more successful by learning from other businesses. How can they do that? They can do that through the Brampton Board of Trade. Not only would you benefit from group discounts, 80% off office supplies, but you'd be part of conversations about the leadership of our community, about the vision of our community, helping to shape that. And we're here on a bi-weekly basis. It's June 3rd. We have our open door discussions that happens at the lunch hour, over the lunch hour. And it's an opportunity for businesses to pop in, to talk about their challenges, opportunities, learn a little bit more about the Board of Trade, speak directly, as I say, to other businesses, other peers that can help you perhaps capture some of those opportunities, overcome some of those challenges. That's June 3rd, but I think we've got one happening. We've got one happening this week as well on the 20th, if I've got it right. Today's Tuesday. Yeah, Thursday's the 20th. We have an outdoor discussion. I'm not going to be able to make it, but it's going to be facilitated by the Queen of Connections in our office, our Vice President, Christy McGibbon. So we look forward to seeing you again at one of our upcoming Board of Trade events. And I just want to say thank you again to our friends at Generation PMCA and our sponsors today, Deloitte, Toronto Pearson, CN, and Goodison Insurance. We'll see you again sometime soon. Thank you, everybody.
Thanks.
Thanks, Todd. Thanks, guys. Bye.